Okay, so welcome and thank you for joining today's session. This presentation is designed to walk you through everything you need to know as a first-time home buyer or just a home buyer, from the very first conversation with the loan officer to the final signature at closing. I'm here to make the process feel less overwhelming and more achievable no matter where you're starting from. And so just a quick disclaimer, the information shared here today is for educational purposes. It reflects general industry knowledge and guidance based on my professional experience at PNC. However, it's not official legal or financial advice. If you have specific concerns or scenarios for your situation, I encourage you to follow up with me at a later time or a licensed professional. Okay, so to start off, my name is Ashley Johnson. I'm a mortgage loan officer with PNC Bank, so I serve Alabama and Georgia. I specialize in working with first-time and emerging market buyers. One of my proudest success stories is that I am currently working with a woman whose husband passed away unexpectedly. It left her with minimal income and no experience managing finances on her own. So when she came to us, she was unsure, overwhelmed, and she was uncertain if home ownership was possible. And so we took it one step at a time. We built a plan, even outside of just buying a home, just helping her with everything in general. We gave her available resources and we restored her confidence in being able to do stuff on her own. So now she's officially under contract for her new house. She's got a fresh new beginning. And so kind of watching her reclaim that independence and be able to do everything on her own has actually been one of the most rewarding moments of my career thus far. I've currently been at PNC for 2 years and 9 months now. So buying a home does involve teamwork. As your loan officer, we will help you with your loan approval, choosing the right product, and guiding you through closing. So navigating the pre-approval process, finding the right loan product, explaining the loan terms in the process, and working with you through the lending process. Your real estate agent comes in helping you explore neighborhoods and homes, providing background information on properties, working with sellers to negotiate the purchase price. Always make sure people know, like your real estate agent, you have to be very careful with choosing them. Make sure that they are someone that will advocate for you at the same time. Talk to you about contingency timelines, guide you through the buying process, and coordinate the transfer of the keys. Depending on your state, because some states you're not required to use an attorney. You can use a title company. So depending on your state, an attorney may also be involved. So they review the purchase contract, they help with title orders, and they may even attend the closing to ensure everything is accurate and in your best interest. So that legal support gives you a peace of mind during a major financial commitment, because I always tell people your home is your biggest investment. So many people are surprised to find that they qualify as a first-time home buyer, even if they've owned a home before. So the Housing Urban Development considers you a first-time home buyer if you have not owned a home in the last 3 years, or if you only owned it with a former spouse, or had property not permanently affixed to a foundation. So this definition opens up opportunities for a lot of people. So whereas some people think that they do not qualify for first-time homebuyer grants and products, if you meet any of these qualifications that are on the screen right here, you actually would be eligible for first-time homebuyer grants and products. Now I'll leave that up for just a second for everybody to kind of take a look at and see if this applies to you.
Involved, or just if you fall into one of these categories, you may be able, I mean, you qualify as a first-time home buyer, but you may not get it if you make too much.
So he's asking, is there a income cap or limit for things like this as a first-time home buyer?
Yeah, so if you're a first-time home buyer, you are just that, a first-time home buyer. Now, the specifics on each product or what that down payment assistance or wherever you're looking at, their stipulations may be a little different. So you'll be a first-time home buyer. However, so for example, with PNC, we have your first-time home buyer, yes, but in order for you to get our grants that are up to 7,500, you would have to fall within a certain income threshold. So you are a first-time home buyer, but depending on the bank you go with, depending on the product you're getting, there are different qualifications for each assistance you get, each resource you go look at. Everyone does have their own. However, that does not mean take away you being a first-time home buyer. There may be some places where that's all you need is to just be a first-time home buyer.
Thank you.
You're welcome. And so let's compare renting versus buying. So renting gives you flexibility, especially if you move often or you prefer maintenance-free living. The number one thing I have on here is let someone else do the work. That does definitely make it easier, like increased flexibility and mobility. You can move as you want to, and you can create additional savings if you're renting as well. And so the benefits of buying, on the other hand, it helps you build equity. It can offer stability and tax benefits. So you got to think about your long-term goals when you're weighing these choices. With buying, there's also the predictability of monthly payments. So sometimes with renting, you never know what that landlord may hit you with randomly throughout the months while you're there. And you also have the freedom to customize your home to make it fit your style. So depending on what works for you, there are benefits to both.
We have a question. Sorry. Go
Oh,
ahead.
sorry. I know there were like calculations versus like rent versus buying. Are those calculations still kind of valid? Like thinking about
Mortgage.
that you're going to spend like 5% of your mortgage per year in repairs and stuff like that. Are those kind of calculations still kind of valid now? If someone's trying to think about like renting versus buying, I guess with the changing landscape.
Sorry, I can't really hear everything you're saying. 5%. I couldn't hear it all. I'm sorry.
He was saying, when you're trying to calculate whether renting versus buying is better for you, sometimes they had like calculators that will help you kind of look at the expenses and measure which might be a better fit. Are those still accurate with the current landscape that we're in? Are there still resources that help you to do that?
So I'm not aware of any. We do not have at PNC any resources. I know that if you go to NerdWallet, is really popular. They do have the rent versus buy calculator. It's a calculator that helps you figure out which option is best for you. So it really just comes down to personal preference and your lifestyle, if renting is good or buying. However, it's always better to pay yourself and build equity than to be paying rent and you're building someone else's equity. You're not investing in yourself. You're helping them pay their stuff down.
Yeah. I know there could be some things there in terms of interest rate that you're getting on like mortgages lately in the last couple of years, math wise, but no, otherwise, yeah, that makes sense for sure.
Did you catch that, Ashley?
Yes. Okay, and so before house hunting, there are always 5 things to do. So first, having a conversation with your mortgage loan officer. This is very important. I have had clients that come to me and they're like, I found a house, I've got a contract, get me financed. And I'm like, what? So it is good to have a conversation with your mortgage loan officer first to know what you can afford. And I always tell people there's a difference between what you get pre-approved for and what you can actually afford. Some people don't look at it that way until I break it down. So it's like you can get pre-approved for a home loan for, it may say you can get a certain amount for a $1,500 mortgage a month. And you're like, okay, that's a lot. That may be like, for example, $300,000, $250,000. But there are things people pay for that we cannot see. So you have to remember those things to deduct as well. So for example, I've got tuition for my kids in school. And so that's not something that's going to come up on a credit report, but I know that these are obligations that I have. And so always take that into consideration as well, because those are things that we do not see. So I always make it a point to ask people, what else are you paying that's not going to come out on a credit report? Because we need to make sure it makes financial sense for you. So just because you're pre-approved for something, there's a difference in what you're pre-approved for and what you can actually afford. So just to remember those little things too, because there is always going to be something else that does not show up on a credit report. So when you meet with your mortgage loan officer, you will then review your credit and your finances, create a budget and decide how much you want to spend, get it pre-approved for a home loan. And then the last one is to consider your plans. So there'll be long-term life plans like job, family, location preferences, things like that. Okay, so when it comes to qualifying for a mortgage, lenders evaluate three main categories. We look at credit, capacity, and collateral. So these are often called the 3 Cs, and they help determine what kind of loan you qualify for and how much you can afford to borrow. So credit score. So when it comes to credit scores, they range from 300 to 850. And yes, 300 does actually exist. We have seen it before. The higher your score, the better your interest rate. So we look at factors like whether you make on-time payments, your credit usage, your length of credit history, and the types of accounts that you have. And so avoid opening new credit during the mortgage process. So I always tell people, once we pull your credit and once we have that pre-approval, I do this virtual hand pop. Do not touch anything. Don't draw funds. Don't do large deposits. All of that stuff is looked at, and the underwriters will ask you if there's some large deposit, if there's a large withdrawal, if you pulled credit, they can see all of that. So it's good to just kind of remain dormant during the process so it doesn't affect your credit score, because that can also affect your rate in the process too.
We
And
have
so
a question
I'm sorry,
online.
go ahead.
It was, can we have a mortgage loan officer pull our, or wait, can we have a mortgage loan office without having a hard pull on our credit?
Yes, so don't let lenders tell you that. Well, I guess it depends on the lender. I always tell people you do not have to have a hard credit pull unless it's required for a certain product. So for example, sometimes we'll have to do a hard credit pull if it comes back at there are some people that don't have any credit, and so we have to do a hard pull to get documentation for that so we can try to build you a credit score. We start off with soft pre-approvals. So we go through TransUnion for that, and it lets us do a pre-approval. It lets us do a preliminary pre-approval without doing a hard credit pull. So we can get you the documentation you need to start house hunting without hitting your credit score if there's something that you know is about to report, things like that. So don't feel pressured to get a hard credit pull. If you feel like, okay, I don't want a hard credit pull, don't let them pressure or bully you into it. That may not be the lender for you. There's always another lender out there that's willing to do what you need to do. Okay, and so capacity. So capacity refers to your ability to repay the loan. We consider your income, your job history, debts, and then we look at how much cash you have for a down payment and closing costs. So this helps calculate your debt to income ratio, or your DTI, as other people call it, which lenders use that to assess your affordability. So we look at stable employment history, gross monthly income, down payment, ability to cover closing costs, and debt to income ratio. So that is all considered in capacity. And collateral. So collateral is the property itself. The home must be appraised to confirm its value and ensure it is adequate to secure the loan. The title report checks for any legal issues or liens that are on the property. These steps protect both you and they protect the lender as well. So the following items help establish the value of the collateral. They're going to be your appraisal and your title report. They are very important. If there is not appraisal that passes or meets the guidelines, then you will run into issues. And sometimes the appraiser may require certain things in order to move to closing. For example, I had one person, they went through government-backed loan, FHA. If there's any sight of mold or chipped paint or water stains in the ceiling, even though that's stuff that can be fixed after closing, because it's a government-backed loan with certain appraisal requirements in order to fund the home, they would have those as required repairs before closing. And so that would require a final inspection. So the appraisal is kind of a gray area. There are a lot of things that can happen when you get the appraisal. You may be hit with a whole bunch of stuff, or it may come back, you're good to go as is. Same thing with the title report. You do not know what you're going to get, but we always wish for the best when it comes back. And so calculating your debt to income ratio to see how much debt you may be able to afford. So it's good to, one, understand what portion of your income will be used to pay loans and other debt. So debt should be below 36% of monthly gross income before including the new monthly home payment. The highest I have seen, and again, this is different per person, each scenario is different. Each person, their financial history is different. I have been able to go up to about 51% DTI with the client. However, that was with FHA, government-backed loan. So for example, if you have $3,500 a month gross income before taxes, you multiply that by 0.36, which would be your 36%. That'd be $1,260. That'd be the maximum monthly debt right there. So your debts included in your DTI are going to be your mortgage and principal, interest, taxes, and insurance. Unless you are putting down 20%, then you would just be, all of that wouldn't be included in your mortgage. You wouldn't have to escrow. You could just do principal and interest. Taxes and insurance could be paid separately. Your car payment, student loans, personal loans, minimum credit card payments, child support and or alimony, and other debts that you're obligated to pay. Again, we can only go by what we see on that credit report. So it's always good to be transparent with your lender about what else you have. So for example, your child's tuition may come up, other loan pay, if you go through like a private lender, like taxes on something, some stuff we can't see on a credit report. So right here, debts that are not included in loan detail, like I just discussed, cell phone, internet, cable, streaming services, car insurance, utilities, dining, travel, entertainment, gym memberships, all those things can add up a lot. And so knowing what you can afford. So to figure out what you can afford, you start with your monthly income after taxes. Then you will subtract the fixed expenses and variable expenses as well as your savings. Whatever is left is your maximum mortgage payment. A budget does give you clarity and confidence before shopping for a mortgage. And so here's an example of the average U.S. household budget. So this shows housing, food, transportation, and other expenses. So comparing your own numbers to this does help you identify where you might cut back or just to make room for a mortgage payment. So when I bought my first home, my biggest percentage was Amazon. I had to cut it down in order for my budget to meet me where I needed to be. And so I'll leave that up there for just a second. Okay, and so let's talk about down payments. So down payment is money provided in the form of, they call it cash at closing. and it can impact your loan to value. So down payments may go as low as 3 to 5%. To avoid PMI, as I said before, you'll typically need to put 20% down, but there may be exceptions to this. So down payment sources will be personal savings, withdrawal, or a loan from a retirement plan. For example, your 401k, gifts, and grants. Gifts from a immediate family member can count as your down payment source. So for certain loans, you would not have to come out of pocket yourself. That money could come in the form of a gift from a family member. Except for FHA loans, at least 3.5% has to come from your own funds. So if you were to go for a FHA loan, you already have to have proof of 3.5% of the loan amount already set somewhere in a 401k or savings or checking somewhere. It does have to come from you directly. So down payments in personal accounts must have been in your account for 60 days. If it has not been in there for at least 60 days, that's where the sourcing part that annoys people very badly comes in. So underwriters will source the money to the place it was made at. If you move money a lot, like going back and forth between a business and a personal account, I suggest that you kind of put a halt to that if you're looking for a mortgage loan. Because again, you will have to source, and once they figure out you've got money coming from a business account, then they will be like, oh, you've got a business. Let's see that full statement. Oh, we see money coming in from the statement. Let's see those tax returns. And that just goes into a whole ripple effect of things you don't want to happen if there's certain things that you don't want to disclose, if you just want to keep it personal and not involve your business. So those do come into play. That's why it's always going to be transparent with your mortgage loan officer in the beginning about what you do and do not want to report as income for a basis of repaying your loan. And so closing costs and prepaids. So closing costs are fees that are rolled into the loan and paid at closing. So you have your appraisal fee, your title fee, your inspections, which are optional, and your surveys, which are optional. Prepaids are paid to the lender for the lender to pay to a third party. So that would be homeowner's insurance, your property taxes, your initial escrow deposit, and your mortgage interest. Some examples of an inspection that are optional, which they're optional, but it's still good to have it. I have had someone that was like, I don't need a pest inspection. I'm not paying $150 for a pest inspection. It's optional. So it went to closing. 6 months later, there were definitely termites in the home. So it is always good to get an inspection, especially if you're in a rural area and you have septic tanks. We always recommend that you do a septic survey, things like that, inspection of different things. And it's always good to get a roof inspection too, because you don't want to go into a house and then a year later you're having to come out of pocket $15,000, $20,000 for a new roof. There are some inspections that we highly, highly recommend. However, they're optional, not required. We just recommend that you get it done.
Ashley, we have a question.
Okay.
Yeah. Okay. So when you're saying fees that are rolled into the loan, but then it says they're paid at closing, so does that become, because the loan is your mortgage, which would be your monthly, what you pay monthly, right? And that usually includes the property taxes and all that. So the closing cost, though, it seems is paid separately up front, or I guess I'm trying to understand the distinction.
Yeah, so there are different lenders that give you different options. So for example, with PNC, when you are buying a home, we offer grants that can cover all of closing costs. So we do not have it where you can roll the closing costs into your loan itself. But there are other lenders out there that may not offer grants and down payment assistance. So when you get to closing, those closing costs are rolled into your loan itself, so you don't come out of pocket. Those are options at different banks. So you wouldn't come out of pocket anything. It'll be rolled into your loan, which would then increase your mortgage payment because it's been rolled into the loan itself. But it can still come in handy for people that don't have cash on hand like that. So you do have different options with different banks, just depending on the product itself. So with PNC, if you refinance your home through PNC, we do give the option of rolling the closing costs into the loan itself. So you would not pay out of pocket at closing. Does that answer it for you?
He said, yeah, that's good to know. Thank you.
Okay, yeah. That's always a good thing to ask too at banks. Like, do you have the ability to roll closing costs into your loan, especially if you don't mind the payment going up and if you are kind of not having that much cash on hand to get the house you want or anything like that, you can see if that's an option. But you also got to remember that can increase your debt to income. If that mortgage payment is going up, you don't want to go over that threshold that will have you ineligible for it. So it's always good to get different options. And loan estimates are super, super important because you can, from the get-go, we can give you a closing cost estimate of a breakdown of every single thing to the dime of what to expect at closing. And so you just have that to go based off of. You can save up money until you get to closing. But yeah, some closing costs can be rolled in. And so PITI stands for principal, interest, taxes, and insurance. So these 4 items do make up your monthly mortgage payment. Understanding each part helps you know what's included in your bill and how your loan is structured. Principal is the monthly amount applied to the principal balance of the loan. Interest is the monthly price paid for borrowing the money. Taxes are the property tax monthly payment. Insurance is your homeowner's insurance monthly payment. And so there are many programs available for first-time buyers. There are grants, down payment assistance, and government-backed loans like FHA, VA, and USDA. With VA and USDA, you are not required to have a down payment. They do offer 100% financing. Your eligibility does depend on income, location, and loan type. And if anyone has any questions later, I can help you explore what fits your situation. I do have people, I tell them if there's a certain area you want to be in, you can go on to USDA website and you can type in the county you're wanting to be in, and it'll kind of highlight different areas where a USDA loan is applicable. And so you can find a home. If you don't want to pay a down payment, find a home in those areas that you're okay with, where they'll do 100% financing. Or if you're VA, contact and see what are your housing benefits, things like that. FHA is just the 3.5% down. They can go lower with credit score. So for us, we can go as low as 600 under FHA. Other lenders may be able to go even lower. But these are the favorable home loan options would be FHA, VA, USDA. And, banks do have their own products. So for example, we have PNC Community, we have Home Ready, and Home Possible under Fannie Mae and Freddie Mac.
Actually, we have a question. And then when
Okay.
she asked it, if you can pause like for 3 seconds so that we can not have feedback. But yeah, we have one question. Hold on.
Okay.
Thank you. For the PNC community loan, what's the least amount that you can put down for the down payment?
3%. So with our PNC community, and we have PNC Home Ready and Home Possible, we go below the 3. The minimum most places do is the 3.5, which is why FHA is favorable. But we do go all the way down to 3%. And that is with you're still applicable for a grant when we do go down to that 3%. So again, I have had clients where only thing they've paid is the appraisal fee and the credit report fee up front. And then once we got to closing, she ended up getting a check back instead of coming to closing with anything, a check back for those fees plus more. So even though you do get in those products, it does not make you ineligible for grants and assistance. So mortgage applications and getting pre-approved. So you can meet with your mortgage loan officer, or you can begin the digital apply process to obtain a pre-approval. Digital links should be accessible on your mortgage loan officer's webpage. For PNC, it is on our specific web pages. There are two types of, so when you get a pre-approved, it is a key early step. It helps you shop with confidence, and it shows sellers that you are serious. You can do it in person, online. It's quick and easy, depending on who you go with. For a preliminary pre-approval for those seeking that but don't have a property address. So as I said before, we can do a preliminary pre-approval, and it can be issued once we have a soft credit inquiry. And you have stated an estimate of your income, assets, and down payment. The preliminary pre-approval does not require us to get income documents. We just go based off of your estimates. So it is always good for us to have documents, but it's not necessary for us to give you a preliminary pre-approval in order for you to start looking for a home and working with the agent. Majority of real estate agents, if they don't already have that known relationship with you, they do require a pre-approval. And then before you're able to put in a contract and a home, most of those sellers, agents do require you to have a pre-approval with your contract. And so for a full pre-approval, for those who wish to be pre-approved for a mortgage loan, but they're not submitting a property address, we can do that one once a hard credit inquiry has been pulled. You have submitted income, assets, and down payment documentation, and a PNC underwriter reviews and approves the file. The full pre-approvals are my most fun to do. And so I tell people we've kind of like flipped the process. So once we have the full pre-approval, you can have that, and it'll be good for months until you find a property, but it will mean that you are done with financing in advance. So a lot of people will find their house, and then they submit the documents, and then, it leads to everybody being stressed out and frustrated. However, if you go ahead and go through the financial process and get your full pre-approval, it makes it easier to where the only thing that you'll need to do is just make sure you re-verify those statements, having the funds to close, and then have an appraisal. So that makes for an easier process, and you're less stressed going through it too. And it's never too soon to get a full pre-approval. And so once you do get the full pre-approval, they'll then give you a commitment letter, which holds more weight. In that letter, it'll say, for example, there's a commitment letter from PNC that we will be financing your home for this amount at this monthly payment at this estimated rate as of today's date. And just committing to you, just a full commitment to you that we've gone through underwriting, we've verified your income, and you're good to go. Just go find a house. So this is kind of the road to getting to closing. So you'll meet with your MLO, you'll go through the application process, which, you'll complete the pre-approval process, then go through your home search, start your shopping, find a home and submit your offer with your pre-approval to that agent. Then you'll go through the loan process, which is submitting the application and the required documents. Again, like I said, you can flip that, and you can do that all at the beginning, giving your required documents and things like that to skip this step and make it go a little easier. You'll discuss locking the interest rate. Initial disclosures will be issued, and then you'll sign and send those disclosures back to us. The loan will route to underwriting, and then you will have a loan processor assigned. So a loan processor is someone that works with us, your originators, in order to get your file to closing. So kind of like your assistant throughout the process that makes sure you have everything you need and make sure you make it to closing. They'll then order your appraisal, submit requested documents. Underwriting will do a final review. They'll issue that final approval. After that final approval, you will then be cleared to close. And so the closing process kind of goes like you'll be scheduled. The amount of cash you'll need to close is disclosed on a closing disclosure, which they also call the CD. The bank and the closing attorney will then balance to make sure our numbers are even. You'll obtain a certified check or a wire, sign the loan documents, get your house keys, and then you will be moved into your home. So these are some potential roadblocks. Some stuff just cannot be avoided. Some stuff may be out of your control. So a low credit score could be a potential roadblock. Not understanding the mortgage products. So if you don't have someone that is, you know, you need someone that's patient with you. So I always tell people like, how you need me to break it all the way down, or what do you not understand? I always want people to tell me what they don't understand, because this is your home. We work for you. If there's something you don't understand with your lender, let them know. And again, if it's someone that's not really working with you, you are not stuck. You're not stuck. You can always choose somebody else. We work for you. We're here for you. If it's not working for you, go to somebody else. Don't feel free to get what you need. It's supposed to be a fun process getting to your home. So title issues can be a process. That's why it's good to have a good closing attorney. Condo and HOA approvals. For anyone that's lived in the HOA neighborhood, you know how fun those can be, dealing with them. Not understanding the closing costs. So getting to the closing table and then you're like, what did I pay for? You go to it and you're not understanding. That can be a roadblock, because you don't want to sign something you don't know what you're signing. Too many credit inquiries. So if you've done a whole bunch of credit pulls, they will ask for a letter of explanation. Underwriters will ask for that, and they will wonder, did a debt come from any of these? And you have to show proof that, okay, I didn't pull anything from this. Applying for this Discover card, I didn't get it. So applying for new credit during the mortgage process. This can affect your DTI. So if you have applied for new credit, that can increase your debt to income and lower the amount that you are approved for. An increase in monthly payments, change of financial situation, negative home inspections. That's a really big one. Appraisal issues and funds to close, high DTI. Those are some potential roadblocks. Did anyone have any questions on any of these?
All right. Nope, we're all good here.
Okay. And so this is kind of an application checklist of what it's good to go ahead and have and be prepared with. So 2 months of your most current asset statements for all banking investment accounts, including the blank pages. So I always tell people, if the beginning of this document says page 1 of 4, don't bring us page 1 of 4, 2 of 4, 3 of 4, and then page 4 of 4 is somewhere missing. That does count as an incomplete document, and they will not accept it. So make sure that you have all statements, including blank pages, because those do sometimes have the URL codes on them that are needed to verify statements. So 2 years of W-2s, your 2023 and 2024 W-2 would be acceptable now. If you have done an extension, then we will accept 2022 and 2023 W-2 and just proof of an approved extension for your taxes. 2 years of federal tax returns with all schedules if applicable. 2 years of business tax returns if applicable for our self-employed clients. A year-to-date profit and loss statement for self-employed clients. Your most recent pay stubs. I always tell people either the last 2 or, depending on how you get paid, the last 30 days. Your most recent statements for retirement accounts like your IRA, your 401k. If you don't have the cash in your checking and savings accounts, you can use your 401k. And then a copy of driver's license or other proof of identity will be needed. Mortgage statement for all properties owned. So if you do already own other properties and you're submitting an application for a new mortgage, then you would need to give your most recent mortgage statement as well as your insurance and taxes for all properties owned, because that will count as debt. Unless you have a rental agreement for those properties, then that could count as income as long as that rental income is reported on your tax returns. If you have rental income and it's not reported on your tax returns, it will then just be a debt from you paying insurance and taxes and that mortgage. So even though we see the rental agreement and we know that you're getting income from it, we are only able to use reportable income. So even though we see it, if the IRS does not see it, we unfortunately cannot use it. HOA condo dues, if applicable. Lease agreements on rentals, if applicable. So again, if it is reported to the IRS, gift letters, which with PNC, if you're going to do a gift, we have those gift letters ourselves and we just fill it in and we'll have the person gifting you sign it. A divorce decree, that's very, very important. I have a client that was about to put in a mortgage application, well, like a home equity mortgage application. And she was like, I'm getting divorced. I'm going to get the equity out this house. I'm going to get my money. That man is gone. Unfortunately, no, he is not just yet. The divorce was not finalized. So I told her you need to wait because, for example, Alabama is a spousal state. So even though you're going to be divorced at closing, you originated this mortgage application while you were still married. So anyone going through any different situation, wait till you get that divorce decree so that you have all the rights and independency of owning your house on your own and don't have to deal with any of the little weeds or anything. Make sure you have that divorce decree. Letters of explanation. So if there are any large deposits, if there are any liens or judgments on credit, late payments on any credit accounts, make sure you have letters of explanation explaining that. It's always good to kind of go over your credit with your lender, and they'll always kind of tell you what to expect from underwriting as well.
We have a question online that says, what if you're on a fixed income like disability and have no tax returns?
Yeah, so if you're on fixed income, then we would just request your last 2-year 1099s. That way we can use the gross income in case there's anything deducted from that. So for example, if you have insurance deducted from your Social Security, that would show in the award letter and we would have to go by that net, but always give your 1099 because that's going to show your gross income. You always want to give the gross.
Okay, we have another question in person.
Mm-hmm.
Okay, I have two questions about the letter of explanations. One is a question and one is more a curiosity. But for the late payment on any credit accounts, how far back? Because I think they stay on your credit report for like 7 years. So if you have, like, let's say 2 months back to back missed payments on a credit account, but it's from like 2 years ago, would you still need to have a letter of explanation for that? Or is it like a certain time frame? Like if you made all the payments since that kind of couple months of missed payment 2 years ago, would you still need a letter of explanation for those?
Yeah, so what we do is we go based off of the last 120 days. So that's what we look at. So unless it was a late mortgage payment before the last 120 days, it's not really applicable to what we look at. So always look back at the last 120 days. And if you see something, say something so that we can know ahead of time, because it's our job to partner with you like Batman and Robin to get you to buying your house. But yes, 120 days is the average.
That's really good to know. And then I guess my second question is just curious, like why would a large deposit be something, I guess, to explain? I can see a large deduction. Like if you get a huge influx of money, is that like a criminal flag or something?
So I can give you an example of something that I have dealt with. So they had a large deposit coming in and we were like, where did this money come from? They had gone to like a quick money place and they had taken out a loan. And so that was a debt that sometimes they don't pull credit score. It was something that we didn't see on the credit report, but it was a debt to be added because it was a loan that went into their account for a large amount. And so things like that. If it's something like you put money from your 401k in order to put it into your checking account to be a liquid asset to be looked at, that's a large deposit that they would need to source. And so they would then ask for your 401k liquidation statement. So like, what are the terms of this? Did you take out a loan from your 401k or did you just pull assets from it? Just a lot of different things that can come from it. Also with my self-employed people, if you have taken a large deposit into your personal account from your business that you don't want us to know about, don't do it. That's a large deposit. They're going to source those funds. They're going to find that business account, and then, oh, let's get your tax returns. So large deposits are to source funds, whether it's a withdrawal or a deposit. Underwriters will source. Nothing wrong with them sourcing. I will say, I just feel like some things just don't have to be there.
Got it. We have
Does that
another
answer your
question here.
Got
Okay.
three questions. First question is, what do you consider a large deposit? Second question, do y'all look at medical bills? Third question, the divorce decree. How many years does that divorce have to be where y'all need that divorce decree?
So regarding the divorce decree, it varies state by state and depends on what's in that divorce decree. I have had where the house was given, the judge had where the house was given to the wife. However, in there, it also said that it's given to her as long as she buys him out with this amount of equity. So it's hers, but it's not all the way hers because there's still equity. And it just depends on what's in that divorce decree. They could still have residential rights for years after. A lot of people request a lot of unicorns in divorces. So it's really goes person by person. You just never know what's going to be in the divorce decree. And so it doesn't really have a certain amount of years back. It just depends on what stipulations that you and your ex-spouse have agreed upon. And then what was another question? I'm sorry.
You consider a large deposit. I know you said you are monitor that. So what's considered a large department?
Large deposit.
So another word for it would be an unusual deposit. So if that deposit exceeds 50% of the gross monthly income, then we'll need proof of that source. So yeah, technically a large deposit that's for conventional though. So it's different for each one. So for FHA loan, any deposit that's greater than 1% of your property's purchase price, they will source it. Sometimes they don't tell you that up front, but that is sourced because sometimes you'll get into it and you'll wonder why they ask me these questions. So if you go government and you go for FHA loan, any single deposit that's greater than 1% of your property's purchase price. So whatever you have in that contract, anything you deposit that's over 1% of that, they will go back and try to source, whether it be towards the end or at that very moment. But they do periodic reviews of accounts throughout until you get to closing. Excuse me. And they also ask for those 2-month statements because they go back 60 days. So if there's anything in the past 60 days and it's 1% or more of what you just agreed on, go ahead and write your love letter to your underwriter. And so it's always good to prepare beforehand. But yeah, 1% if you're going FHA, conventional, if it's 50% of your gross monthly income, they'll source it.
And
was
then
there
also
one more
he had the
question?
question of medical bills. Do they count medical bills as a part of your debt and the debt to income ratio?
So medical bills that are reported to the credit bureau, like in collections, or
Yes,
just
that
medical
have been
bills.
reported to collections.
Okay, so typically we don't calculate medical bills into your debt to income. So we see that it's there, but as far as the DTI, we don't calculate it into that.
We have another question.
I guess there are a few questions that are like more like having a business related. So if your business is like a S corp or a LLC and it pays you and you have the W-2s from that, do you have to also turn in the business tax returns, or can you just say that the business is your employer and give them the last 2 months of W-2?
Yeah, so if you W-2 yourself, you do not have to give business tax. I'm sorry.
Okay, you can go now.
Yeah, so with corporations, so with the LLC, yes, they will ask for business tax returns. With if you W-2 yourself, you can just submit those W-2s to yourself. However, if you have moved any bit of that money from that business to your personal, um, in a way that's not through a pay stub or like direct deposit, they will catch wind of it. So just you don't have to give tax returns, but just be careful with the money movement.
In 2 months time span, right? Like 60 days.
Statements, yes, 60 days. Yes.
The other question is no, it's fine.
Okay.
I'm good.
Okay.
Sorry.
Oh, wait, we have one more.
Do they count the like? Do you have to do the study to see how much your business is worth if you do have to submit your business tax returns?
I'm sorry, what was that?
Do you need to have your business, like the worth of your business, like appraised if they ask for your business tax return? And would that count? I guess would that factor into your DTI at all?
No, so they wouldn't have it appraised. They would go based off of so are you saying to use your business as income or
Yeah, if you do, say if you go the other way and you want to use your business as income and you also want to tell them that you own the business, do they take like how much the business is worth as a possible asset into that account then? And would that count factor positively or negatively or whatever into your DTI?
so it would so they look at those expenses. I always tell people they look at that bottom line number. So your business can be worth $5 million. If you have expensed out $4 million, then you're only worth $1 million. So they look at everything after expenses. So it can kind of make or break you depending on how you file and how you expense everything out. So again, each scenario is different. Each scenario is just going to be different with business owners.
Okay. And then we have another question.
Where in the home buying process should you expect to have to start spending money? Sorry if this takes us back to the roadmap, but I've heard of some people, I don't want to say getting scammed, but paying maybe more for parts of the process where they shouldn't have.
Yes. So with PNC, I can speak for PNC. I'm not sure about other lenders, but the only thing that you pay as the upfront fee is going to be your appraisal fee and your credit report fee. Everything else is optional. And if they have found themselves paying other little fees and things throughout, they need to relook at their agent and what's in that contract. Because most times I've seen where they're like, we paid for this and we paid for this. Like, where is this money going towards? And I'll go look and I'll be like, okay, well, you asked for on your contract, the agent has you paying for their commission, you're paying for the other agent's commission, you're paying for a home inspection. They have you paying for a warranty company that they're a partner with. They have you paying for pest, septic, and you don't even have a septic tank. You've got all this stuff on there. So that's where they kind of get scammed paying those fees in the contract because those inspections are optional. They'll find themselves paying $450 for a home inspection, $150 for a pest inspection. Homeboy may be a roof inspector. They give him $200, and that's normally part of the home inspection and appraisal. So that's normally where I see some of the scams coming in at will be extra things added to the contract that can be unnecessary. And if you're not choosing those people yourself to go out there and do those inspections, if you're going through the agent, sometimes there are contracts or people they may know or partner with. Unfortunately, that does happen.
She said, thank you. And then also we had a question online that says, where on the roadmap should we expect to pay the appraisal fee with PNC?
So at PNC, you pay for that appraisal up front. So once you pay that appraisal fee, your appraisal will then be ordered within the next the next day after that. So the sooner the better. If someone is getting a home inspection, I'll always kind of tell them to correlate it with the home inspection, because if your home inspection it just looks like crap, that appraisal isn't even going to help your case in buying this house at all. So if it doesn't, so I wouldn't want someone to pay $450 for a home inspection and then over $600 for an appraisal fee, because then you've come out of pocket $1,000 for a house that just isn't even going to work for you. So I would say, let's see. Is this back on is the roadmap back on the screen?
Yeah.
Okay, so I would say, so where it has loan routes to underwriting and loan processors assigned, once you have received that email or they have said to you, hey, you are conditionally approved, that means we've approved your income, you're good to go, we just need a house and maybe a couple other documents, but you are conditionally approved subject to this. And you just have stipulations you need to meet. So I always would wait till conditional approval, or once you find that house, once they sign those documents, once the seller signs, go ahead and have a home inspection ordered, and depending on what that is, go ahead and pay for that appraisal right after that home inspection. But that's why your agent will also guide you on what that looks like, and it depends on if you're going through a quick closing, like less than 30 days, or if you've extended out to kind of give yourself some grace and some time. Or you can order it after we get the intent to proceed. So it just varies per person.
So I think from in person, I think we're good on questions. Anybody else have any last minute questions, or online, any last minute questions from anybody? Oh, we have one question here. It's all good.
So how do you know what lender which lender is a good fit for you? Because I think I started the process and I found one lender. They approved me for FH loan, but the amount was low, but the programs they don't participate in. So how do I know exactly who to go to?
I tell people it's kind of like dating. Yeah, get all those uncomfortable questions out the way, because you're trying to see if this person works for you. So you start off, make a list of questions. So number one would be, what's the minimum credit score? What's the maximum DTI you all require for your loans? What are your different products? What down payment assistance programs are you already approved with? What down payment assistance and grants do you offer? What are the requirements for that? And based off those answers, you can kind of self-answer yourself on if this works for you. So if they say we're not partnered with any down payment assistance, you would go find that on your own. You swipe to the next lender, because that may not work for you, because you may need assistance with getting down payment assistance. You may need grants and things like that. So it's just asking the uncomfortable questions, because again, I always tell people, do not be scared of us as lenders. We work for you. If it doesn't work, go to the next one and figure out what works for you. If they don't have the products, someone else will. There are, like, again, PNC is not, we are wonderful, but we're not the only lender. We may not work for you. So just asking all those uncomfortable questions right off the bat. I've noticed a lot of lenders are very impatient with people asking all those questions, or act like they don't have the time. If you run into that, it's not worth sitting there trying to force someone to answer those questions, or just, work. Yeah, it doesn't work. So just, again, asking uncomfortable questions, treat it like dating, get all those hard questions out the way, and make a list of what's important to you. So give them your list. Like, this is what's important to me. Do you meet those qualifications? So it's not about, like, if you meet theirs, do they meet yours? Look at it that way, and you have a way better experience.
Can I ask a question?
Hmm?
You mentioned before something about 401, using your 401k. What did you, how would you use that?
Yeah, so you would contact your employer, so your HR department, and you would ask them how you would go about pulling from your 401k. We do suggest that you talk to your tax accountant or consultant and look at all the different penalties and things, because if you are under a certain age or if certain things don't apply to you, you can be penalized with fees in pulling from your 401k, or you can also do a 401k loan. That is an option as well. But you would go through your human resources department and let them know. So, for example, with PNC, my 401k is through Fidelity. And so I would contact Fidelity and say, hey, I'm trying to buy a house. I need to pull this amount from my 401k. What cash can be made available to me? What penalties will I get? What terms do I have for me to pay this back? So you would contact HR and see who holds your 401k and see what they can do and how they can assist. And sometimes it's good to talk to HR because some people don't know their employers offer down payment assistance. So that's an option too.
Okay, thank you.
You're welcome.